Hi, Michelle. How does our focus on smaller borrowers influence our approach to underwriting size and concentration? And how does all of this impact the risk-return payoff for investors?
The size of the borrower doesn't change our approach to how we underwrite a credit or how much we hold of a single credit. Instead, it influences our strategy more broadly when working with a portfolio of smaller borrowers. In our case, we're talking about borrowers in the lower middle market with EBITDA between $5 and $50 million, averages about 20 to 25 million. Smaller borrowers can be impacted more quickly by financial performance decline, so the structuring of loans is very important. As a result, in the lower middle market, you typically see lower leverage, lower loan to value, tighter legal documentation, and finally, financial covenants in every deal. Financial covenants are very important because they are set at a level that trips as financial performance declines. As a lender, you can then have a conversation with the company proactively to understand how they plan to correct the performance. Hand in hand with lending to small businesses in the lower middle market and more highly structured deals typically comes higher pricing. Additionally, strategically, we've decided that we will only lend to lower middle market borrowers that are owned by private equity sponsors. Smaller borrowers have less experience typically working through difficult periods. Sponsors have the experience to guide borrowers and access to resources such as capital. We find we have a better recovery when sponsors are involved. Finally, your initial question asked about managing a concentration risk with lower middle market borrowers. We manage concentration risk the same regardless of size of borrowers we are dealing with within our portfolios. We think it's best to run a very diversified portfolio, so we typically take maximum 2.5% to 3% positions in a single name. We try to protect against any one individual credit materially impacting the performance of the overall portfolio.
Diversification is absolutely key. Now, taking into account the current environment, how does deal flow vary between lower middle market relative to upper middle market, and where are you seeing opportunity?
Deal flow over the last 18 to 24 months has been below historical levels, broadly speaking, in the market. Muted M&A volumes have been driven by the higher rate environment. At FEAC, we've been fortunate to return to somewhat normalized volumes because of the unique aspect of deal flow we are experiencing in the lower middle market. We see deal flow from two primary sources. The first source of deal flow is to sponsor transaction, which is where we've seen the most decline in terms of M&A volume. The second source of deal volume is from founders, entrepreneurs, private businesses selling into private equity for the first time. This is where we've seen most of our deal flow coming from over the last 24 months. Because you're dealing with smaller businesses, it lends itself to this type of transaction, so it becomes a unique source of deal flow for us in the lower middle market. The source of deal volume is also influencing the industries that we're seeing most. Lower middle market private equity has started to focus on the acquisition and roll-up of companies and industries that you might think of being family-run, family-owned, and more local and regional economy-based. Examples might be HVAC, plumbing, elevator servicing, landscaping, tree maintenance, etc. These transactions provide an exit opportunity for small business owners and value for private equity looking to develop and scale a small business.
Thanks, Michelle.